Welcome, Isaah Mhlanga, Chief Economist at Alexander Forbes. Today we are going to be discussing the public lecture delivered by Governor Lesetja Kganyago at the Wits School of Governance on the 18th of June, 2020. Welcome, Isaah.
Thanks, Prof, for having me.
I think the best place to start perhaps would be just to get your reflections on your main takeaways from the governor's public lecture, and if you could summarize the main points for us and what the speech means for West Africa is at today.
Thanks, Prof. I think firstly it was a very timely public lecture from the Governor Lesetja Kganyago, given that we have a number of debates from a macroeconomic policy point of view, which are informed by where we find ourselves as a country from an economic growth perspective, which comes because of COVID-19. But one of the reflections that I have from the governor's speech is that he painted a picture which we all know. Firstly, that the economy was already in recession before COVID-19. We already had an unsustainable fiscus before COVID-19, and COVID-19 just exacerbated that. But because of the expectations of a deterioration in the fiscus, there are increasing calls to say the central bank must do more to try and alleviate the impact of fiscal, the impact on the economy that we have. So my first takeaway from the governor's lecture is that what seems to be transpiring in the policy debates is that there is somehow a sense that fiscal problems can have monetary policy solutions. And I think that's a very important message which the governor tries to bring out, to say it's not possible for fiscal problems to be permanently or sustainably be addressed by monetary policy solutions. Hence, even the calls of quantitative easing, even if they are well intended, they cannot be the solution for our fiscal problems. So first, we need to guarantee fiscal sustainability. Once we guarantee that fiscal sustainability, monetary policy can play a supporting role to try and alleviate short-term pressures that largely come from COVID-19. Beyond that, we need to do the structural reforms that are going to lift economic growth over a sustainable period of time. It cannot be the role of fiscal policy to address, monetary policy to address those. And perhaps secondly, he outlined in a detailed technical fashion how quantitative easing can be done, and also the continuum through which it can be done, because there is a tendency in our country to say, because the United States is doing it, because the UK is also doing it, or the Euro area is also doing it, therefore South Africa should be able to do it. But it doesn't take into account the nuances between the differences that these advanced economies are engaging or are using quantitative easing to how it is being used in developing economies, for instance. So he outlined that continuum to say, firstly, is the provision of liquidity to bond markets to make sure that they function properly as is expected. Secondly, there is what is called yield curve control, which essentially means depressing long-term bond yields to make it cheaper for the state to borrow. And then on the far extreme, which is what is practiced in advanced economies, would be outright purchases of bonds from the primary market, which means simply printing money and giving it to the fiscal authorities to spend. So those are the varieties of quantitative easing that are being used. So he outlined, we are not at the far extreme where the central bank would purchase bond in the primary markets, meaning directly financing government. We are not in that particular camp. We are more on the provision of liquidity to make sure that bond markets, they function as is expected, which is the much lighter version of quantitative easing, if we were to call that. We are not even in the space where we are doing yield curve control, because it was very clear to say the central bank is not targeting a particular level of bond yields, which means we are not even doing yield curve control. We're simply providing liquidity to make sure that bond markets function appropriately as they should. And he demonstrated with the fall in bond yields to pre-COVID-19 levels, it seems the bond buying program which they embarked on is working up to this point in time. And I think the other point that he mentioned was really to say, in the public debate or public discourse, there is this sense that these unconventional monetary policy moves comes at a free cost, which means there are no costs, there are no consequences. It can be done without any harm. That is what is transpiring in the public discourse. But he tried to highlight that there is no free lunch. All the decisions of monetary policy comes with some difficult trade-offs which would have to live with. And if you're looking at quantitative easing in particular, you have to make sure that it's not inflationary. That's one of the trade-offs that we have to make. But also, we have to make sure that it's not costly for the state. If we are going to use reserves to run that QE, it may result in the depletion of those reserves, or else it may come up with other problems, which means the markets will no longer believe that the credibility of a central bank over a long-term point of view is maintained, and as a result, it's going to lose the value in the rand as a currency. It's going to lose. It's going to decline over time. Examples that were mentioned, for example, if you just look at our neighbors north of the Limpopo River, Zim, which means if you just look at the value of that Zim dollar, it has declined quite significantly. And if you were to just take one number, the inflation in May was over 800%. That is an example of how a central bank can lose its credibility in managing its own currency. So that is just one big point that he made to say there are costs to unconventional monetary policy, which we need to be able to understand and be able to make trade-offs of whatever we're trying to do relative to those costs. And that's one of the issues that we had. And lastly, one thing that also came out is if the National Treasury could, or government through National Treasury could come up with a consolidation path or a way that would make our fiscals to be sustainable, the central bank will have much more room to ease policy, or even to move from a QE light, which is just provision of liquidity, to a middle ground where they would even do yield curve control. That is possible, provided the fiscus does what it needs to do to make sure that the fiscal problems are fixed and we guarantee fiscal sustainability. Or else the central bank would have an unlimited request to continuously fund government, which will of course lead to bad macroeconomic consequences as far as inflation and the loss of value of the rand is concerned.
So it would appear to me that the key challenge that we face as a country is that of fiscal sustainability, and an issue that has been on the agenda on government's agenda for a couple of years now, and something that was to be resolved through structural reforms, and we've not seen much action or movement on this front. And as you know, the longer we are circling in one place, we're not going to have that breakthrough, and therefore any actions by the monetary, by SAP through monetary policy tools will not necessarily get us beyond where we currently are stuck. Is that the sense? Is that the message the governor was sending?
No, absolutely, Prof. That is exactly the message that the governor was sending, to say we have fiscal sustainability problems, and they need to be addressed from the fiscal authorities, not from the central bank. The central bank can provide a supporting role by injecting liquidity where markets malfunction, provided, of course, the fiscal sustainability is guaranteed by the state. Without guaranteeing fiscal sustainability, monetary policy can play a role, but its role will be limited, or it can even exacerbate the problems that we have in fiscal policy by creating another monetary policy on top of it.
Yeah, because I think one of the arguments would be, for an example, that economic recovery or positive activity in the economy by the markets depends by and large on confidence, the confidence they have on government to manage, for an example, debt levels over a sustained period of time, to undertake other actions that advance structural reforms in the economy. So would it be correct to suggest that perhaps action by monetary policy authorities alone would not be sufficient to restore confidence in the economy?
No, absolutely, Prof. Monetary policy, by and large, is not responsible for the broader macroeconomic policy setting in the country. Neither is it responsible for structural reforms that make sure that we boost productivity in the economy. Because ultimately, the reforms that are required are those that should boost productivity across the whole economy. And that is outside the gambit of monetary policy. But also the other point that the governor put forward strongly is the central bank does not put in place what targets the monetary policy is supposed to meet. It is the lawmakers that puts those targets. And so far, for now, we have inflation targeting, which means we control inflation so that it lies between 3 to 6%, but also taking into account issues of financial sustainability within the financial system as a whole. That is what the central bank is tasked to do. It's not currently, through the constitution, it's not tasked to help in terms of fiscal sustainability or funding government directly. It's not tasked with that. So that point, it may have been subtle, but I think for me, it came out very, very strongly to say, should there be a need to actually ask of the central bank to finance government directly, then it is the function of the lawmakers to make sure that they actually make it explicit as far as the requirement of the central bank to make such a move. It is not going to be the central bank that will come and say, by the way, we can now finance government directly by doing quantitative easing. The central bank does not have the powers to do so.
So are open market operations of the central bank clearly defined? Do they have clear limits?
Absolutely.
That they would decide when and how to use depending on their reading of the macroeconomic environment.
Absolutely. Open market operations, really, you could say it's still a version of quantitative easing. It's still on that continuum because it entails the central bank either buying bonds in the market or selling bonds in the market to affect the quantity of money supply in the system. And that is what the central bank does. It has been doing that for a very long time. It does that on a weekly basis. By conducting repo markets. In the repo markets, it does that every week. So it's not something new. It's still in that continuum. which is really just to impact on the liquidity in the markets and to make sure that markets are functioning in a smooth manner. It has limitations, of course, which are that it cannot really help the fiscal authorities as far as financing is concerned.
And your response to the critiques of the governor and his approach to, some would say that he has decided to lean on the conservative side in a time of crisis. What exactly is driving this pressure for the central bank to place its foot to accelerate the printing of money, or rather to produce inflation as a tactical approach to promote growth?
Prof, you see, in this country, the debates we've had as far as the central bank is concerned are somehow polarized. But what we also observe is that all the problems in the economy, the single institution or the few institutions that seems to be still working and executing their mandates appropriately, they are required or they are requested to do more by doing what other institutions are not doing appropriately. So if you look in terms of the debates around the central banks as far as boosting economic growth, the question that we always, or the point that is always made is we need more funding from the Reserve Bank. They must finance directly economic activity, whether be it small businesses or large infrastructure programs, the central bank should finance. But to date, there isn't anyone that have come with a clear proposal to say, first, what infrastructure? And then, why isn't it being financed from the fiscus, by the Treasury? Because that is what the Treasury needs to do. If you go back from the 2000s, most of the fixed investment, it took place through state-owned companies, which obviously operate on the back of guarantees from National Treasury, which means it's supported by the fiscus. And we're able to drive a lot of investment in the mid-2000s to just before the financial crisis. Then that has changed significantly because we have ramped up a lot of debt since the financial crisis, over $1 trillion, but it did not go into infrastructure investment. And no one wants to talk about that, to say, how did we use that funding? No one wants to talk about that, except to say, we need more funding from the central bank. No one wants to say what will be the conditions, when will this funding come to an end, so that we know clearly that to say, this is extraordinary times. Yes, there could be calls for the central bank to do more than what it normally does in normal times, but it needs to come up with clear conditions of when will the central bank stop such activities, for instance, and what are the conditions that will be required for it to do these unconventional policies, what are the trade-offs, what are the costs that would have to incur as a society. Because the risk that we run is that the credibility of the central bank will decline quite significantly, such that we have a lack of confidence in our financial system as a whole. That will result in capital outflows significantly. We have seen it happen in other countries. The example is our neighbors north, Zimbabwe, where they are experience significant difficulties of attracting foreign direct investment, which is a requirement. It's a requirement that is quite necessary to boost domestic economic growth. It comes with technical know-how as far as running some of these economies are concerned. So that's the risk that we run, to reduce or to dent the credibility of the central bank as far as its management of the financial system is concerned, and preserving the value of their currency is concerned. Which the central bank, or through the government, of course, is not willing to lose, because it was gained through hard work to make sure that the world over, the South African Reserve Bank is one of the most respected emerging market central banks. And it was achieved through consistent safeguarding of the financial system, and making sure that the policy environment, as far as monetary policy is concerned, is predictable, investors know exactly what they're dealing with in terms of monetary policy predictions going forward.
Perhaps the last point, Isaah, is in about 3 to 4 days' time, on the 24th of June, the Minister of Finance, Minister Tito Mboweni, will be delivering his budget vote for times of crisis. What can we expect from the minister, and also especially in light of the fact that the forecast suggests that we're going to experience a budget deficit of 14% of the GDP this year in 2020, and in 4 years' time, we're likely to face a sovereign debt crisis. Is there likely to be a sense of urgency in the budget speech, a clear direction on structural reforms, and a sort of credibility offered on the front of fiscal sustainability, which is the area that the governor of the Reserve Bank underlined in his speech on Thursday?
Prof, if we are to be honest, our country finds itself in a difficult space, and I think the finance minister is going to outline in detail that before COVID-19, the economy was already in a technical recession. It has already been moderating in terms of its growth for many years. In actual fact, if we look between 2010 and 2019, average economic growth rate was 1.7%. If you take the last 5 years to 2019, average growth was about 0.8%. So we were already having very slow economic growth rates. And then we get hit by COVID-19, which forced economic shutdown across sectors, which means we are going to have a lot of company bankruptcies, which means corporate profitability is going to decline significantly. And as a result, corporate income tax collections are going to underperform. The loss of jobs that will come with bankruptcies, which we are already seeing across many sectors, will also come with loss of personal income tax, which means it's also going to underperform. And that loss of jobs, again, would mean that from a spending point of view, which affect VAT collections, we are going to also get a hit. Again, if you take the global environment as well, where all the major countries are expected to contract, which means they are going to demand less of our exports, which means import duties are also going to contract. So all the major taxes that we use to collect revenues are going to be hit negatively. That is what the finance minister is going to communicate to us. And as a result, because the expenditure side is not yet moderated, we're still spending as much in terms of social spending, but because of COVID-19, we have an added expenditure that is required to deal with COVID-19. So our deficit, the difference between the tax revenues having collapsed and spending having increased, means the fiscal deficit is going to be much wider than what was expected at the time of the February budget. At that time, it was expected to be about 6.8% of GDP, which means it's going to almost more than double to about 14% of GDP. And to finance that, would need to increase our debt, which is why the debt to GDP ratio is expected to hit 80% of GDP as of this year, and then rising to about 100% of GDP in 5 years' time, or even more, contingent on whether we're going to be able to do the structural economic reforms that can boost economic growth. So that is already something that is happening. So what can be said about the future? What is required for us to generate a sustainable fiscal path and avoid potentially going to the likes of the IMF for structural adjustment program, no longer just a COVID financing, but for a structural adjustment program, because we will fail to service our debt over time, or we have to embark on significant cuts in spending, social spending that is actually required. So we need, at least from our own estimates, at least a minimum of 3% economic growth, just to make sure that we return back to 2019 levels of growth in 3 years' time. But that 3% is not going to be enough to ensure fiscal sustainability. So now, to ensure fiscal sustainability, we need economic growth rates of 4.5% over the remainder of the 20s up to 2030 for us to ensure that we have a fiscal that is sustainable. By that, we mean we are able to service our interest costs. But that is even not enough. It just gives us back the economy that we had before COVID-19, which is not what we need, because it was not enough to generate jobs for the masses of people that remain unemployed, which means to actually generate jobs, we need economic growth rates that are higher than 4.5% sustainably. And for us to get that, we need to embark on the structural economic reforms. But unfortunately, those are not implemented by National Treasury. They're implemented by various departments in government. So they need to coordinate and make sure that they implement those robustly without fail for the next 10 years for us to generate that growth that is going to ensure that, one, we are fiscally sustainable, two, we generate enough jobs, but also three, we don't get back the economy that we had before COVID-19, because it doesn't deal with the issues of inequality and lack of job creation. We actually generate a new economy that can absorb the masses of people that remain unemployed.
Well, it seems like we need miracles. We need miracles. I will leave it there, Isaah, and thank you so much for your insights, as always. Thank you.
Thanks, Prof.